Good evening, ladies and gentlemen. Welcome yet to another Mayberry Investment Forum. I'm your host, Dan Theok, Senior Vice President of Investment Banking. I'd like to thank you for joining us yet again, where today we'll be looking at the Q4 results for Dolla Financial Group. On the panel today, we've got an illustrious panel, by the way. We're joined by Group CFO Trevine McKenzie, who's online. Welcome, Trevine.
Thanks, Dan.
And in studio, I can't even say I'm the rose between two thorns. We got on my right here Ken Roy Carr, the Group CEO. Welcome, Ken Roy.
Thank you, Dan.
And then the new kid on the block, new to our program at least. On my left is David Henriquez. He's the CEO of Ultra Financier. Welcome, David.
Thank you, Dan. Thanks for having me.
And I'll be asking lots of questions about Ultra Financier, guys, because we want to know what that is and how it contributes to the profitability of Dolla Group. Great to have you guys back on the program. Special thanks to David for his first time joining us. I want to give apologies for Chairman Berry and Gary Peart, who are unavoidably absent today, but they are more than replaced by our group CEO for Mayberry Investments, Patrick Battier. If they're a fan of the content, then don't forget to subscribe. Also hit the bell to stay up to date with the channel. We upload content like this just about once every week, twice this week if you did the program yesterday. Additionally, if you want to embark on your very first investment journey, you should take that first step with Mayberry, of course. Follow us on social media to learn more about how you can get started today. Great. So up first, let's do this presentation on Dolla Financials. We're going to look at their Q4 results, the full results for 2024, actually. Let me just take a moment to remind you guys that this is the company that IPO'd in May 2022. Did I get that right, Ken Roy? It was the most famous junior market listing ever of all times. We're going after about $500 million and getting $5 billion in subscriptions. It was like crazy oversubscribed. I remember borrowing money and throwing $10 million at it and getting less than $1 million. And I was like, what's up with that? It was crazy oversubscribed. Came out at $1. And it just really hasn't disappointed, quite frankly. So let me give you the quick recap over the years. We're talking about a company in 2021 that did $168 million of profit, had $1 billion of assets. By 2022, they had $2 billion in assets, did $295 million in profits. By the end of 2023, they had $3 billion in assets, did $419 million in profit. And by the end of 2024, guess how much assets they have? $4 billion in assets, and the profitability is up to $453 million. So combined annual growth rate of about 29% over the last 4 years. It slowed down a little bit in 2024, and I'll definitely be asking, hey, what's up? Because I was expecting, closer to $500 million of profitability for the year. But we'll talk about that. I think greater things are to come, and it's still one of my favorite junior market listings that has delivered incredibly in the last 2 years since they've been on the stock market. Stock price is now at $2.84. So if you came in at $1, or like me, you had to come in at $1.80 because you couldn't get none to buy at $1 flat, you're still feeling pretty good. You're still up by over 100%, and it's a stock that still has great potential for growth. Now let's look at the numbers in detail. For the full year of 2024, interest income was up by 31% to $1.5 billion. Net interest income was up by 24% to $1.24 billion. So far, so good, doing pretty good. Operating expenses up by 32% to $707 million, and that resulted in the profit before tax being a little bit compressed, only growing by 8%. And similarly, net profit tax and EPS also growing by only 8%. And I'm saying only 8%, guys, because I expected more. Still great results. Again, this is a company before IPO that didn't even break $100 million. By Q1 2023, they're doing $100 million per quarter and have kept up that quarterly run. So it's really impressive. Assets now up by 53% to $4.58 billion. And this is why I really do expect the profitability to get to at least $500 million, and I'm going to presume it's because of the timing of when they drew down loan funds. Let me help you out. Is that correct, Ken?
That is accurate.
It's the timing of when you got the loans relative to when you're able to disperse them to get one full year's earnings?
That's correct.
Okay, say no more. So we're going to have a better 2025 no matter what, folks, just because of that. And then they've managed total liabilities reasonably well. They're, borrowing debt to fund the business, on lending that debt, making a good spread, and that's basically the business in a nutshell. Total equity up 17% to roughly $1.15 billion. Balance sheet looks really clean. They've grown the business really nicely. They've managed their NPLs and ECLs really well. E-sales are, amazingly low. NPLs have crept up to 9.9%. We're going to talk about that, but as long as they're less than 10%, I'm still feeling really good about the business. They're making over a 30% spread. It pairs on the interest income, and so you're going to have some NPLs. And the reason why I presume the e-sales are so low, Kenroy, is because you've got great security.
Secured loan strategy, right?
So that's what helps protect the e-sales. So NPLs being non-performing loans, e-sales being, in old school terms, your bad debt provision associated with those non-performing loans. So I'm going to ask questions as I go along the line. $4 billion in debt book. What percentage of that would you say is secured?
Well, as at December 31st, that would represent about 86% of the loan portfolio.
86%
is
of
quite
your
significant.
loan book is secured, and obviously with adequate security.
Adequate. And in terms of security, we refer to like real estate, motor vehicles, and suitable shares. So whether all of those reputable institutions that are listed on the Jamaica Stock Exchange.
Yeah, good deal. So good secured book, good quality book. We're going to see interest income spreads improving and interest income for the full year improving. So 2025 must be a better year than 2024. Current PE is 15.7 times. So junior market average PE nowadays is about 16, 17 times. So they're just a little bit below the junior market average. That average I expect will improve to about 18 times as 2025 rolls out. As interest rates come down, we're expecting PEs to grow higher. So I think average main market PEs today, which are about 8 times, will go to about 10 times, and junior market PEs, which is about 16, 17 times, I think will go to 18 times. So I think the stock is undervalued, specifically relative to the growth potential that's there, and the fact that this last year's earnings, although showing an 8% improvement, I think should have grown more by 25%. CAGR for the last 4 years, as we said, was 28% combined annual growth rate, that is. And so I think the business for 2024, could have done better if they dispersed those loans sooner, but it's still great performance. I don't mean to criticize in a way that says I'm not happy. I'm just saying I'm going to be even happier as the full year's impact of that loan book rolls out. The largest loan you took, you probably got that in September, October of last year.
That's correct.
So that's explaining the timing. That was like $1.6 billion or something like that. So the largest aspect of the loans that they drew down to start impacting the business, they would have only had maybe 2 months of those loans in the financial year. So when we see the 12-month impact of that, I think the profitability is going to be much better. It's great to see trailing earnings actually $450 million, so that gives a better feel. And market cap at $7.1 billion. So again, junior market company came out 2 years ago at $1. Market cap then at about $2.5 billion. They've increased the valuation of the business roughly by threefold, and they still have lots of legs to go. Looking at the profit by quarter, as I said before, they broke 100 million in Q4 2022, and what we see here now is in the last 10 quarters since then, only one quarter where they didn't make $100 million profit for the quarter. And I'll be asking Kenroy, hey, what happened in the third quarter of 2024? Other than that, you can see the quarterly profit trend is looking pretty impressive. I think it's only going to get better. On the next slide, we look at the movement in the share price, and it's been trading, in that $3 region, up and down, give or take, for the last year and a half. So the market isn't yet quite catching up with the growth and profitability, but that's going to come. Interest rates were spiking last year. 30-day CD rates peaked in July, like at 10, 11%. Now, 6-7 months later, they're down to 6%. You're going to see that turning up in the stock market pricing in very short order. So I'm excited about that. So stock has traded pretty tightly in the last 52 weeks, a high of 292, low of 280. I'm going to predict that this stock is going to jump by 30% over the next 12 months. Profitability, I expect to be up to at least 500 million, just based on where they are. And if they increase that debt book further, which I would imagine they will intend to, we've seen the trend $1 billion, $2 billion, $3 billion, $4 billion year over year for the last 4 years in a row. So following that trend, I'm going to imagine they'll grow that debt book by at least $1 billion this year, and then that will give them the legs to go to $650 million of profitability. So just as a little financial analyst guy, that's how I see it. I love this stock. I love this company. Declare conflicts from Mayberry. I believe the Mayberry Group collectively, we are the largest shareholder in Dolla Financial's We wrote a check, a big check, over $1 billion to get to that position. So we didn't get there at $1. We bought into this maybe 12 months or so ago at a much higher valuation because we saw the potential of the business and we believe it will continue to grow. So that's my analysis in a nutshell. If I sounded like I was rushing, it's because I'm excited to get to the Q&A and to hear these guys talk a little bit more about the numbers. So first up, I want to start with the new kid on the block, David. What is Ultra Financer, and tell me how you fit into the wheelhouse and what's your contribution relative to this $453 million profit made last year?
Hey Dan. So Ultra is the new kid on the block. We started in November 2022 and we cater to the high net worth individuals. As Dolla received their microcredit license, they could only lend to a certain aspect of the market. And where Ultra fits in is the high net worth individuals that Dolla could not lend to. Ultra can now sit down and we can service that market. So therefore, we came into the market 2022. Our current loan book is sitting at about 1.5 billion. So, we are a significant portion of Dolla's loan book. But, we're a pretty small team, pretty new, and slowly grow. Well, we're growing pretty quickly, but, taking our time to ensure we're doing everything right. So we are here to cater to that high net worth bracket. And continue to keep our loan book as secured as possible, as we aim to keep it 100% secured.
Good deal. And then talk about that. So what percentage of your loan book is secured?
I would say 98% of our loan book is
Excellent.
secured. Yeah.
Excellent. So you represent about 40% of the group's balance sheet of 1.5 billion, of say 4 billion, and about 90% of your debt secured. And you're targeting the high net worth. So
Yes.
what's your typical loan duration and loan size, would you say?
On average, our loan duration is about a year, 12 months. We do have a couple of customers who have pushed to the 24-month, and obviously those who take pretty short bridge loans, 3 to 6 months. And our typical loan size sits somewhere in the range of 12 to 25 million on average, but obviously we do have a couple big ones on the book, up to 100+ million.
So if I need a $50 million loan because I need a 90-day bridge, I'm buying a house and I just want to do the bridge for 90 days and I want to borrow $50 million, you guys will do that for me if I provide adequate security.
Yeah, definitely.
Okay, sounds great. And Kenroy, what's your loan book look like in terms of concentration risk, like by industry? Just describe. So he's doing the high net worths.
That's correct.
You're sort of doing something different. I'll let you say what that is. But what does it look like by industry?
So while David's focus is on the high net worth individual, we manage the books for micro, small, and medium-sized enterprises, as well as persons who earn individual consumers who earn less than $10 million per annum. In terms of the industry concentration, I'd say that we have a well-diversified portfolio. With the major sectors contributing would be the real estate sector and trucking, haulage, and transportation. Those two combined probably represent about 50% of the portfolio, while the remaining 50% is spread among the retail industry, manufacturing, and those other industries. But we do have a cap in place that we put on each industry to ensure that we're not too overexposed to any given industry at any given point in time, hence ensuring that the quality of our loan book is always up to the best it can be.
Good deal. And then talk to me a little bit about that adjudication process or loan review process. I mean, how does that work? How are you trying to make sure that you're giving good quality loans?
Most definitely. So while I won't give you too much of our secret sauce, while I won't give you too much of that secret sauce, the prudency is very key to us. So we do have an internal team that reviews applications up to a particular limit. We have systems in place that we have credit models in place, where it has to be pulling a credit report on a customer and just assessing all the different variables of the application, ensuring that the customer shows ability to repay, ensuring that we assess the collateral prudently to ensure that once we take on the asset, it is something that can cover the loan in the event of a default. And we do have other limits. So where the loan is like an ultra loan, for example, those would go to the board based on the size, and all of those controls are in place to ensure that the quality of our asset is superior at the end of the day.
Yep, sounds good. So, Trevine, you've been quiet. So, let's talk about ECLs and NPLs. So, I've been privy to see a market study that looked at the NPLs and ECLs. And guys, I'll say it one more time and then stick back to my acronyms: non performing loans and express credit losses. So, I've been privy to a report that shows you guys are like best in class in terms of NPLs and ECLs. Having said that, I mean, I did see your NPLs creep a little bit up to 9.9%. Still very good, because I think the industry average that I saw was closer to 16%. And then more importantly, the ECLs were down at like 3%. But tell me a little bit about the NPLs. So you've grown your loan book over the last 4 years from 1 billion to 4 billion, but your NPLs have kind of crept from say 7% to 9.9%. Could you just talk me through that a little bit and give me comfort, why I shouldn't be worried?
So first of all, definitely no need to worry about the NPL. You mentioned the most important factor. It's within the industry average. Well, it's below the industry average, and we've tried our best to keep it that way. But as you know, last year was an interesting year in terms of the economy. There was uncertainty here and there. And then we did have a couple loans on the books that went into a non-performing state. Nothing to worry about, because as you know, these loans are secured. So we are in the process of curing these loans, and it should return to the 8.5% average that we have been maintaining over the past few years. But these are secured loans, so we're not worried about them at all.
And tell me, what exactly to you means an NPL? What's the trigger that makes it become an NPL? And then in terms of security, tell me, in general, what type of security coverage ratio you guys typically look for in general, because I know you don't want to give away too much of your secret sauce.
So a loan becomes non-performing after 90 days in arrears.
Okay.
So if you have not settled up to 90 days, then it does go into a non-performing state. And I believe that is the definition right across the board. So
Okay.
there's no variation. Dolla doesn't define it
You
for
don't have your
ourselves.
special definition. Okay, gotcha.
Yeah, and
Right.
just to sell and cure the default. So
Correct.
so in some of these cases, we're actually in those processes, and we should be seeing a reduction once we're able to adequately liquidate these collaterals.
Got it. And back to you, Trevine. The ECL now, that's sort of a function of saying, okay, the thing is an NPL, but what's the security like? What's the probability of default? What's the probability of us actually losing money on the transaction? That's how you ultimately kind of end up with your ECL?
That's correct. That's absolutely correct. So we have an external party, a very independent external party that does carry out this analysis for us, and this is done on a quarterly basis. So that gives us confidence that these numbers that we're putting out into the public is as accurate as possible. And historically, we have seen where once we are audited, these numbers still hold firm. Our rates are pretty standard. In terms of our time to sell, we're looking at about 12 months in some instances less. It all depends on the collateral. And yeah, so we have tried as best as possible to ensure that the loans that we have on our books are secured. And as Kenroy had mentioned before, that these loans are secured by real estate, motor vehicles, and shares. And those are the types of collateral that allows the ECL to be as low as it is.
Good deal. And how are things looking in 2025 so far in the same front in terms of NPLs and ECLs? So you've done, roughly a month and a half in 2025. And how are you guys feeling about NPLs, ECLs, performance of the loan book, your ability to disperse loans, that type of stuff?
We believe it's pretty stable at this time. We see no real fluctuations in NPL and ECL where we are now. Of course, the NPL when we landed December 31st was at 9.9, and we're, working assiduously to get it down. But we believe it's stable at this moment. Our ability to lend also is stable. We find that the first quarter of the year is not the fastest quarter in the year in terms of sales, but we do have our sales officers working on that. We do have enough capital to sustain us throughout the first quarter. And the good thing is that we did a great deal of work in Q4 in anticipation of this slower period. So we will see that income will not drop because of the fluctuations that we have seen in the past. So we have, built in a model for that to ensure that we're able to work in and get our income in.
Good deal. Patrick, I see you're itching to ask a question. Please feel free to go ahead. What questions do you have for the
Sure.
team?
4%. Talk to us a little bit about the strategy to manage those as well as continuing to improve or grow profitability.
Well, the good thing about Dolla, and we've seen it historically, is that we have been maintaining a strong efficiency ratio. So I don't believe we have been above 50% in the past few maybe years, which does say that most of the income is going to the bottom line. Now, in 2024, we had big plans for a larger expansion than we actually had. And because of that, we would have ensured that the company has the capacity to manage that expansion. Now, this expansion will be coming later, which means it will be happening in 2025, and we are now prepared to do that. So we saw an increase in expenses in 2024 to get us to that point, and we don't expect that we'll see a corresponding increase in 2025 for those expenses, because we are where we are, we have what we need, and we'll just be maintaining that going forward.
Good deal. So, Trevine, we saw the trajectory. I mean, the numbers don't lie. 1 billion to 2 billion to 3 billion to 4 billion. Can we expect that debt book to grow even further in 2025? Any chance you guys be coming to the market to look for funds, and we'll keep trying to grow your loan book?
It's a part of the business, Dan. That's how we grow. It's our inventory, so we'll definitely need cash.
Okay, great. Well, we look forward to that. So, folks, remember you can start sending in your questions. And I sort of inadvertently took one question just now from Limitless Podcast. I do want to ascribe that to him. And the idea that, yes, I do believe you will see Dolla coming to market this year to raise additional funding to keep growing their debt book, to keep growing the profitability of the business. I think that's just going to sort of be a given way of life going forward. Who do I ask this one to? So somebody's asking, we keep hearing about a possible IPO for ultra financiers. So the white elephants in the room, I'm going to throw that one up at the pretty girl, Trevine. Do you have a response to this question?
Unfortunately, the response is the same as we have been explaining for the past few quarters. An IPO is a great thing for any company, any newly incorporated company, to put it at that. So we are ensuring that we're doing the analysis to make sure it makes sense for our investors and for the company on a whole. But as soon as we have more information, the public will be the first to know.
Appreciate that. We're not trying to get you in trouble here. Omni3460 asks, Kenroy, any new loan products for the future?
So we have been looking at our suite of products. I believe that we have a product that covers, we kind of have a broad suite that covers, any particular need that a customer may have. And what we have been doing over the last several quarters have been emphasizing and making adjustments to one or two of our products just to tailor to better fit the demand of the market. So for example, in the last quarter, you'd have seen where we had a promotion, the 100 to 1 Drive campaign, which is a product coming from about 2 years ago, but we made some tweaks, made some adjustment, and that product was really successful in the last quarter of 2024 and has been successful so far for Q1 2025. So we will continue to just look at those products, look where the demand is, and look at what the customer really wants from us, and make the adjustments to those products and take them to market.
Good deal. Limitless Podcast is asking Trevine, ideally, how much more funds would you want to raise this year? To grow your debt book, I guess you say.
So based on our analysis, I believe 2 to 2.5 billion is somewhere in the ballpark of what we would be looking to raise this year. But as usual, we'll keep everyone posted.
Good deal. And one-on-one Coco Investor is asking, would a $5 billion book be sufficient to provide revolving loans without further borrowing in the near term? So let me take a shot at that. One-on-one, I think what we're saying is, as long as the business maintains healthy financial covenants, there's sort of not really any constraint to how much they can grow the business. So we've seen them go from 1 to 2 to 3 to 4. Trevine's implying that they're going to go past $5 billion this year, as a matter of fact. So as long as bankers like me are happy and satisfied that the business is doing well in terms of, net margins and cash flows and that type of things, NPLs and ECLs, we will keep funding this business to allow them to keep growing. So I would say one-on-one, in 3 to 4 years, I'd like to see this thing at a $10 billion book. That's not impossible because what they're doing here is providing, a great service to folks who need short-term financing in most instances. And then they've mentioned the strategy of focusing on high net worths, versus the normal retail folks, and the constraints that they have under that Micro Lending Act. So there is no limit to how far they can go, and I'm sure Limitless Podcast would agree with me. Ryan Purcell, let me read this one careful. Mayberry being the champion of the junior market, will any of Dolla's subsidiaries be accessing that $750 million funding limit approved by Parliament? So again, Ryan, we're not going to speak to that in this moment. I'll be honest and say we're always looking at how we can grow the business. And I believe growing this business requires us both raising debt and where the opportunity allows us also to raise equity. And we think that makes sense. We'll also obviously look at that. And Philip Burgess says, when will the bonds be listed on the public market? So Philip, I think the next raise they do, it's certainly our recommendation to give consideration to doing that next raise as a public raise. And so let's see what happens in the next 90 or so days. Philip, you might be surprised. I personally think it's a good strategy for them. They've raised over $2 billion of funding from accredited investors, from high net worths. So I say, hey, it's time to give retail customers a chance to participate in this type of fixed income instrument. And I can't think of a better company to recommend than Dolla Financial. So Mayberry Investments, we're in the market. We're going to be wrapping up our $2.2 billion raise in the next week or two. And that's gone pretty well for us. And I think Dolla Financial should go forth and do likewise. But let's see what their board ultimately decides, guys. So just bear that in mind. I'm not saying it's absolutely going to happen. That's a decision that they would take and make the decision there. O'Neill Johnson says, are there plans to expand into St. Anne and St. Mary, or were those shelved, Kenroy?
Well, we do have a location in St. Anne that is in Discover Bay. But I believe that we have done an assessment. Our latest branch was St. Thomas, Marant Bay in St. Thomas, and that branch has been, it's been open for about 7 months now, has been pretty successful. So we have been looking at different areas. The need, I don't believe there's a need right now for another branch in St. Anne because we do have people on the ground. So even in places where we don't have a branch, there are representatives because our sales team, and this is also taking a moment to just highlight and really big up the value that these persons add just to the overall disbursement and the growth of the company. But our sales team are not accustomed or have a culture of sitting in branch and just waiting on persons to come in and visit. We actually go there and hunt the business, hunt it, kill it, and drag it home. So we will continue to just be present in the market, whether we have a first physical location or not. But at this point in time, I believe we have 11 branches across Jamaica, and that is pretty a solid number that's working for us right now.
Good deal. And any thoughts of digital type solutions? How do you feel about that?
We have also been exploring that, and I believe eventually it will come. Right now we're focusing on operational efficiency and just looking at some of the systems that we can automate internally to accommodate some of those customer facing applications that would make the service more efficient that we deliver to our customers.
Okay, good deal. Hey, Patrick, any additional questions from you?
Or Dan, just one more. Can you share what strategic initiatives do you have in place to further improve operational management?
Could you repeat that, Patrick? I didn't hear that clearly. What further initiatives?
Correct. Strategic initiatives to further improve operational management.
Okay. So I believe we just made mention of, I just made mention of one, which is just looking at some of the tasks that we perform internally, some of them being very manual tasks. where I believe the resources that we have in terms of human resource can be diverted to areas of the business that can increase efficiency. So we're actually looking at some of those areas to see how best we can automate processes, whether it be workflow related to the loan application process. And for this year, we'll also be focusing on automation of our complete collections process as well, which will be supported, of course, by the collections team. But I believe that some of those critical automation are really essential to improving overall efficiency for the group.
Good deal. Hey, David, I got a question for you. You know, I've got a E63. It's probably worth $20 million, and I want to borrow $5 million for, 90 days to do something. Will you accept my car as collateral?
Yeah, definitely, Dan. I mean, I know the car, so definitely.
That was a hypothetical.
But no, definitely.
sure.
With that, we love that type of thing. I mean, obviously we take a look at the unit itself, ensure that it meets the standards, and that it's something that can be liquidated if the time comes or the
Right.
need arises. But yeah, definitely.
Right.
That's the market we're sitting in.
And can folks get sort of pre-qualified, so I sort of have you as a standby facility so that when I do want to get the loan, I can access it quickly?
Definitely. I mean, we are in the business of personal lines of credit. So, I mean, if we can build a relationship where, you are someone that a recurring customer, that's exactly what we want. We have, let's say, possession of your asset in the way of a title or a lien registered on your motor vehicle. Then you've paid off your loan and you can come back. It's quick and simple, and it makes life much easier for you and I.
Yep, and how quickly can you make something like that happen if I actually have the collateral in place and I want to just have that as a sort of a standby line, and then I want to be able to come to you and access a 5 million here or a 10 million there? I mean, how fast could that happen if we were pre-qualified?
I mean, if you're pre-qualified, meaning all paperwork is in line and everything, the collateral is in place, I mean, we can turn over funds to you, I would say, within 24 to 36 hours. But it really just depends on how quickly you can have your ducks in a row.
Right, gotcha. No, it's definitely a great facility, and I think a lot of people don't appreciate that. I mean, it's what we do at Mayberry with what we call our margin loan book. It's $8 billion of business where we lend money to folks on a short-term basis using their shares as collateral. And the biggest feature of that facility that we offer is you can get that money in 24 hours. And so it's amazing to see high net worths come in. They want to buy a house, and the mortgage is going to take 90 days, and they're probably going to lose the opportunity to buy the house. So they want to show up buying the house as a cash sale. They come to me and say, "Hey, Dan, I want to buy an apartment for my daughter. It's going to be $50 million. Can I get the $50 million from you?" And I'm like, "Sure, you can get that, in 2 days."
Going forward, you can channel to David.
Yeah, well, absolutely.
We're here to support you.
Because I won't take the car as collateral. I won't take the watch. I won't take the boat. I won't take the yacht.
Right.
I'm not a big fan of real estate financing, so for sure we'll happily collaborate, and we can work out some economics on that, a small finder's fee or something. But I'd love to support you guys in any way we can. Right, going back to the questions online, I can see one-on-one Coco using his or her brain really sharply here and saying, would you consider a preference share offer to give back to shareholders a chance to profit from some of the company's borrowing? So again, they'll consider anything, guys, that makes good sense. I mean, as shareholders in the business, you guys all have an equal share of the profitability. You benefit in the increase in the share price. At some point in time, the business is going to be looking to do more creative forms of financing. At some point in time, I definitely believe they're going to need to raise more equity for the business, and they'd want to do that responsibly. And we're going to look at all of the creative ways we can do that one-on-one. So who knows? It could be a preference share, it could be an IPO, it could be a rights issue, it could be an APO. They're definitely going to, I think, be looking to come up with something creative. So as soon as that 750 limit is settled, and somebody asked it yesterday, is that going to be only for new companies, or will existing companies be able to make use of that $750 million threshold? As soon as we have certainty on that, I bet you these guys are going to be one of the first movers in the space. But one thing is for sure, we saw the trajectory. They're going to find a way to grow their loan book this year, one way or the other. 2022 was $2 billion, then $3 billion, then $4 billion. So you can do the math on what the market's expecting them to do this year, come hell or high water. So Ryan is saying fire on the APO. I don't know if you're suggesting you don't like the idea of an APO because my Jamaican patois reading isn't the best, but again, they're going to figure out a way to raise equity that adds value for folks, and I'm sure you guys are going to be happy with it, whichever way we go. All right. I think we've exhausted most of the pre-questions I had, and I just want to again recap. It's a business that's done $453 million of profitability. The PE is at 16 times. I think the stock's undervalued at $3. I think the stock's going to grow by 30% this year. I think the profitability needs to get to $550 million this year after they roll out the impact of the debt they already have on the books. I think they're going to borrow another $1 billion this year alone and grow the profitability even further to $650 million. And this is just me speaking as an analyst. I don't have no inside information. Sure, I help them raise funding when they want to raise the funding. That's about it. This is just me speaking as an analyst, looking at their combined annual growth rate, which is 28% per annum, running for the last 4 years, and looking at the profitability, making a good guesstimate on what spreads I think they should be making on the money that they borrow. We can see that they're borrowing from the market at 12%. We can guess that they're on lending somewhere between 40 and 48%. So that's like a 30% plus spread. So it's like the math is kind of easy for me. So this is a great business. At Mayberry, we love it. And that's why we put a couple of $1 billion behind getting our position. And I think we're going to see this business grow from strength to strength. So 2-3 more I see coming in. What are the loan book targets for Dolla and Ultra individually for 2025? So, David, how are you hoping to be able to grow your loan book in 2025? So you're at 1.5 billion today. That's about 40% of the group's books. What would make you happy in terms of an outcome for 2025?
So we'd like to be sitting somewhere with a loan book around 2.4 to 2.5 billion by the end of 2025.
Good. So you want to grow by $1 billion, and would you say you have the pipeline of activities that you believe would make that an achievable target for you?
Yeah, I do. I mean, the fact that we've been able to achieve, 1.5 billion in basically, call it 2 years of business with a team of 3, and no real sales reps out there hustling and just being very conservative in our approach. I do think that as we increase our intensity into 2025, I think it's very achievable.
Good deal. I appreciate that. Ryan Purcell raises a good point. So I agree. I'm more in favor of a rights issue over an APO, but I wouldn't make the comparison of look at NCB struggling below price, and we don't want that for Dolla. I think in the case of NCB, the elephants in the room, you've got 2 or 3 big sellers of that stock, and that's a part of the problem. I mean, NCB probably traded over $4 billion last year, as in trading, and I think it'll trade another $4 billion this year. That's much more than what they raised from the APO. I think the APO is just badly priced. Had they priced that APO at $55, they would have raised the $5 billion, but it still wouldn't have solved the problem that there are some big selling shareholders in the market between Michael Leach and Patrick Hilton and Dennis Kwan. There's no doubt that between the 3 of them, probably want to sell $10 billion of the stock, and maybe only $6 billion has been sold in the last year. So I think there's like another $4 billion of overhang, and that's the biggest problem to NCB in my view, Ryan. Let's watch them for 3 more quarters. We just saw the quarter results come out. It was less than my expectation. They need to do at least $4 billion a quarter attributable to shareholders. They were less than $3 billion. So that's kind of like, I'm not so happy with this last quarter's results, but I want to watch them for 3 more quarters. I want to see those 3 selling shareholders we mentioned come out of the market, and I bet you they'll be out of the market in 6 months' time. And with 2 or 3 more good quarter results, NCB stock will be up by 50%. So I think that's the NCB story, and the main reason why that share price is a little bit depressed is because there are these big selling shareholders in the market trying to offload the stock. In the case of Dolla, it's like the complete opposite. We bought more than $1.5 billion worth of Dolla over the last 18 months, and we had to do a deal to get that stock. You can't go on the open market and buy $1.5 billion worth of Dolla, and we paid a good price to get that stock price, and we ain't selling. So if there's a rights issue, you guys better get in line because we'll be taking up our share of that rights issue. So I agree. Let's go for the rights issue. Looking forward to it. There's no comparison in this way between Dolla and NCB. NCB is a great company. Don't get me wrong. Best in class in their space. And Dolla is a great company, best in class in their space. There's no comparison in that way. And I'm a big fan of NCB, but I know I'm got to hold that stock for another 2 years to really see it come to its full potential. Whilst I'm going to bet you guys we're going to see 30% growth in Dolla stock over the next 12 months. So let's wait and see. We'll definitely have these guys back over the next couple of quarters. So first up, the run rate needs to be at least $100 million a quarter. If you don't make $100 million a quarter, somebody's getting spanking. I'd prefer for it to be Kenroy or Trevine, but we'll figure it out. So that's the run rate going forward, Trevine, 100 million a quarter or higher. Ultimately, in 6 months' time, it's going to be 125 million a quarter because you would have had the full impact of having that $4 billion. And we're going to be happy about that. Okay, somebody asked about dividends. Hey, what's up with the dividends? Are you slowing down? The last one was significantly lower than usual, or are you guys just making some adjustment? You know, what can we expect in terms of dividends going forward? Kenroy, if you feel comfortable.
Sure. So I believe the we paid dividend last quarter would have been lower than expected because the in Q3 our results were lower than expected. To be quite frank, we have seen improvement in Q4. I believe it's Q3 was one of the first quarters that we did not hit $100 million in
correct.
PBT for a number of years, and we have already exceeded that $100 million PBT in Q4. Of course, as you said, Dan, a lot of the growth that we've seen in profitability for 2024 would have been as a result of the bulk of the disbursement happening in the latter part of the year. So you'd have seen where the loan portfolio grew by 50%, for example, but profit grew by 8%. So we'll really be seeing a lot of the benefits of those disbursements as we move into Q1, Q2, and as we continue to raise funds to grow the business further in Q3. And those things will have impact on the dividend payment. We have declared a dividend on the Q4 numbers, and I believe that that is an improvement over the Q3 numbers. So those are things that we'll take into consideration, along with just the other key things that we have to be very prudent about as a business, whether it be the cash flow, how we reinvest, to relent to our customers, and just meet the demand of the business. So we'll take all of those stuff into consideration.
Yep, I appreciate this. And again, from Limited Podcast, this is a great question. I'm going to throw this one out to you, Trevine. What has Dolla learned from the Hurricane Beryl impact, and are you ready for the upcoming hurricane season?
So, getting ready for the hurricane season is a very interesting question for a lending company. In my previous job, it was a whole thing, but learnings is just that we understand that when it comes to the first half of the year, it's not necessarily the time where lending is at its most. Persons are focusing on many different things, and we have adjusted our projections and our expectations to manage that. But in the midst of it, we understand that now is the time when we need to push to ensure that we're able to basically match up to what we are expecting. So marketing is there. Marketing is doing everything they can to run the promotions and get everything out. We have our sales officers who have gone through their sales training for the year already and are ramped up and ready to work. And we also have collections as well on the back of that. They are also most important during times like those, when persons are not necessarily inclined to want to make payments on their loans, they want to hold cash. We have collections that is also ramped up and has gone through their annual training to be ready for that. So it's just a matter of looking at the resources that we have and maximizing those to ensure that we're able to manage during this time.
Great, thanks for that. I appreciate that. And Patrick, I will check in with you to allow you to ask the last question. After that, I think I'm going to look to wrap up. I think this has been a great session.
Dan, I think you've covered most of my questions, so nothing from my side.
All right, good deal. Well, with that, I definitely want to bring this program to a close. I think it's been very informative. It's been great discussions. These are some of my favorite people to have in the room. I'd like to thank my viewers for tuning in. As always, their support's always appreciated. Big up to Trevine, to Kenroy, and to young man David for being a part of the show. We really always enjoy having you guys here, and we look forward to having you back hopefully next quarter when the results will be bigger and better, and they better be more than 100 million. I'm spanking Kenroy.
They will be.
I'm sure they will be. I'd like to thank Patrick Battier, our CEO, also for being a part of the program, for his insights and his contributions. Folks, I'd like you guys to join us next week when we're talking to Wigton Energy, and we'll have the CEO, Gary Barrow, there to deliver the results. That program will be hosted by Rachel Curlew, because I want to take away myself being a board director of Wigton myself. If you guys are curious about the updates of our virtual investor forum, then find us on social media. We share live stream dates and our upcoming guests on our official social media pages. Also, give us a follow to learn about all things forum related. And don't forget to subscribe to our YouTube channel. I really hope you do. Please subscribe, hit the bell, hit the button, whatever you need to do. It's Mayberry Investments Limited, and click on the bell to receive all future notifications. So, Dolla team, thanks for being here. Really appreciate you guys. Viewers, thanks for tuning in. Remember, wise investors, slow and steady wins the race. Keep safe, everyone. Bye-bye.